So what we're going to discuss today is Chapter 1, Accounting and Business. And basically, we're going to go over 4 simple points. I'm going to explain the importance, right, and the purpose of accounting, right? Basically what accounting is. We're going to identify users and the uses of opportunities in accounting. I'm going to explain why ethics is a huge part of accounting. And I'm going to explain GAAP and define the accepted principles. Right? It probably should be a 5th one because we'll do some transactions. We're going to do it in simple form, and we'll also do look at the accounting statements in the very end after we deal with GAAP. So in accounting, what do? We identify and record and communicate information. We identify, record, and communicate information, right? Accounting is an information measurement system that does this, right? And we are recording what? Relevant, reliable, and comparable information, right, of the organization's business activities. When we say it's relevant, we are recording information that is material. That is material. Material information, I think it's in 2. Material information is information that can influence the decision of a rational investor. It's information that can influence the decision of a rational investor. Think back on economics. A rational investor is someone who is sane, can make decisions on their own, and they are they have the ability to be fully informed, right? They have access to all information. They don't have to necessarily be fully informed, but they definitely have to have access to the information. If information is not material, then we classify it as immaterial. Okay? That is, immaterial is information that cannot change or influence the decision of a rational investor. So what we're identifying is if information is material or immaterial. Material information gets recorded, immaterial information gets filed. We keep it for a later day, right? As an accountant, you want to make sure that you have more than enough information. You want to be basically on an information overload. Now, the information you give may be, you may delineate through it. You might say, well, I'm going to give the people this information, but not this. But you want to be the most informed person in the room. Everyone with me? Are you with me? Yeah, okay. And then once you get the information, you want to communicate it. You're going to communicate it to the stakeholders, to users, right? You have to communicate it in their language. The information that is relevant, as we were talking about material, information has to be reliable. We're going to go into ethics in a second. One way that you know that information is reliable is because what? The person that is giving you the information is ethical. We'll talk about what makes up that ethical portion. And comparable. Can you take the information, 2 sets of information, right? Information from ExxonMobil, information from Chevron, and compare them without having to make any or few adjustments. You don't want to have to pick up Exxon's paperwork, Exxon's financials, and then you pick up BP's financials and see that BP is in euros or British pounds, and you have to do a conversion to compare it with ExxonMobil. You want to be able to compare information right there on the fly. So the information has to be comparable. There's two types of users that we are preparing information for in accounting. External users and internal users. External users composed of lenders, people that are outside the company. Lenders, shareholders, government agencies, consumer groups, external auditors, and customers. Internal users are people within the company. Managers, officers, internal auditors, staff, anybody from the C-suites. Does anyone know what the C-suites are? CEO, CFO, COO, CMO, right? Chief Executive Officer, Chief Financial Officer, Chief Operating Officer, Chief Marketing Officer, onward and so forth. I even heard last night for the first time a CNO, Chief Nursing Officer. Johns Hopkins has one. I was amazed. I was, wow. Because everybody's going to get a C. Eventually, you will have a C, A, for A, a B, a C, all the way down the alphabet. Now, for external users, we're going to be using financial accounting. And for internal users, we use managerial accounting. For this course, we will be concentrated on external users. This is a financial accounting course. That's all we will talk about is external users and how to create financials for them. Opportunities in accounting, there are several, right? From consulting to FBI investigators, right? So these are just a list of some of the opportunities in accounting and what percentage, where do people go, right? Majority of them go into private accounting. Some of them go into government and some of them go into public accounting. Ethics. As I stated before, when it comes to information has to be relevant, reliable, and comparable. The reliable section of this, ethics, is a big base of it, right? The accountants have to be ethical. They have to be ethical in two things, fact and appearance, right? The fact might be that you're going down here to Wells Fargo to make a withdrawal from your account. But if you go in there with a black ski mask, a black hoodie, black Timberlands, and a black SUV, you pull up to the front, you keep the door running, and you run in there with a bag and a gun, you don't look like you're there for a withdrawal, a legal withdrawal. You look like you're there for a withdrawal. Oh yeah, but not a legal one, right? So the fact might be you do have an account, you just want to make a withdrawal. But you look like you're robbing the joint. So excuse us in Loudoun County if we call the police. Everybody with me so far? So in accounting, you not only have to look like you're factually telling the truth. I mean, you not only have to tell the truth, you have to look like you're telling the truth. Right? That's what many of our politicians have a problem with right now, right? You know, doesn't matter what you say, if it doesn't look like you're telling the truth, then excuse us, the American public, if we treat you like a liar. Everybody with me? Right. Also, when it comes to ethics, right, we think about what environment needs to be set up that could that a fraud could transpire, right? What's the environment that could create a fraud? In the environment, we have this thing called the fraud triangle. And what it states is that there's three things that you basically need to have a fraud happen. And the base one, or the most, probably the one that's most fundamental, is you need opportunity, right? You might want to rob your employer all you want to, but if your employer is, I don't know, Fort Knox, that's a little tricky, right? So you may not quite have the opportunity. Everybody know what Fort Knox is? It's a place where it used to be where all the gold was held, but now it's different things, and it's on a military base. Everybody with me? So that might be a little complicated. So first of all, you've got to have the opportunity in which to commit a fraud. Secondly, rationalization. Rationalization is, you start saying things like, well, my boss used the company car and went out on a date last night. Why can't I just use the car this week? That makes sense? You start to rationalize misuse of assets. And then the last part is financial pressure. Okay? Are your bills behind? Right? Do you have college payments due? Or are your student loans behind? All those things can have pressure, right? Do you have family members that have medical bills, right? Or do you have a medical situation? All those could have pressure, financial pressure, on you, and cause for you to start down the path or create the environment of doing a fraud. Everyone with me? So that's the fraud triangle. Congress passed back in 2002 Sarbanes-Oxley, right, to help curb some financial abuses. And this is just a list of some of those abuses that happened over years, but culminated during that period of time. I'm not going to go through them. You can look them up. You can look at them in the slides. But just wanted you to know that there were things that happened in the past that has made our industry more vigilant as far as, especially with ethics. We also have Dodd-Frank. Dodd-Frank is a banking law that has come to pass, and is our most recent banking law, right? Promote accountability and transparency within the financial systems, right? And put an end to too big to fail, or at least try to. So, all right, so when we're doing financials, financial accounting is governed by the concepts that we call GAAP, or generally accepted accounting principles, right? GAAP aims to make sure that the information is relevant, reliable, and comparable, right? We call this U.S. GAAP. There's also international standards. So there's a U.S. standard and there's international standards, right? And both of them have been born out of two different circumstances. U.S. standards mainly were born from the private sector, and they are mainly concerned about getting it right as far as the what an investment is, right? So you'll see certain principles and certain assumptions that are a little bit more conservative, because they are trying to make sure that outside investors know what they're investing in before they get in. International accounting is mainly concentrated on for government entities, and is for tax purposes, to make sure they're getting their correct amount of taxes. So a lot of times in international accounting, they'll be a little bit more lenient on some of the principles and allow you to be more progressive in your valuations. They'll let you bring valuations up. Now, why would they allow you to bring valuations up? Why would the government allow you to overvalue an asset instead of undervalue? It can tax you more. Everybody with me? Are you with me? Internationally, they are run by the International Accounting Standards Board, or IASB. They do the international standards, right? Our standards are done by FASB, and our U.S. oversight, our governmental oversight, is through the SEC, which is the Securities and Exchange Commission. Right? That is where our government oversight comes from. International standards, right, in today's global economy, the demand for us to really be on one standard has arisen because a lot of companies, they have financials in, they have a presence in the U.S. as far and as well as abroad. So they don't like making two different sets of financials. However, we tried what's called convergence, which is to create one set of financial standards for both U.S. and international. It has not worked out. So we have kind of stalled in the convergence model. So there are a lot of similarities, but we are not at the point where they're exactly the same. So general principles are the assumptions and concepts and the guidelines of preparing the financial statements, right? General principles stem from these long time used accounting principles. And then you have specific principles, right? They are detailed rules in reporting the business transactions. And here are 4 principles and 4 assumptions that we have in when we're doing U.S. accounting. One of them is the measurement or the cost principle. I like to call it the cost principle. The cost principle states that whatever you purchase something for, you need to put it on your books at that amount, right? Stuff is based on actual costs. So if you bought, let's say, a piece of land here on Route 7, it was valued at $1 million, but you bought it from a family member for $1. You need to put it on your financials at $1, not $1 million. Everyone with me? That's the cost principle. Revenue recognition principle provides guidance on when we recognize revenue. Right? We'll do more of that in chapter 2. There are certain, certain standards in which we go by in which to recognize revenue. Not just revenue, but expenses. The measuring principle or the expense recognition principle is prescribes when companies must record their expenses. And then the final principle we'll talk about in this chapter is full disclosure. Full disclosure principle requires that a company disclose all material information. That a company discloses all material information. I love full disclosure because this is where you go in the notes of companies and they disclose all those intricate details of different things that they're doing that you're like, wow, whether it be, I don't know, Google cars that drive themselves or Waste Management, who has decided that I believe most of their landfills now have driverless vehicles on them in their preparation to try to have your trash picked up by driverless vehicles. Eventually you'll pull maybe they'll have like a chalk line or something for your trash can, and you just pull it into the trash line, and like a driverless trash truck will come and get it. That'll be interesting. So that's full disclosure, right? So all those things get found out in full disclosure. On the other side, you got going concern assumption. Did you have a question, buddy? You have a question? Oh, all right. Going concern assumption. Going concern assumption is the assumption that the company will be around in a year. That's the first part of going concern. The second part is that they'll be still engaged in the same business activities, right? And they'll be around in a year and they'll still be engaged in the same business activities. Companies move, they evolve, they become new things. So, you know, some of you might be like, why would a company change their activity? Because they get into different business activities and they just evolve as time goes on. Everyone with me? I mean, you look at Netflix, they started off as just literally mailing you DVDs in the mail. I don't even know if you can get a DVD. I don't even know what to do with a DVD nowadays. I have DVDs at my house, and they're no different than the pictures on the walls. They look, it's like aesthetic. It's not. It's not actually to break out the DVDs and watch them. Everyone with me? So Netflix started off as that, and now they're not just streaming video. They're doing what? They're creating content. Right? Netflix is producing new series, new movies. So they've gone a long ways from where they started. So companies evolve. So we have full disclosure, going concern, right? Because sometimes we're concerned that the company will be here for a year, but the other part is, will it be doing the same thing? I don't know, I'd have to look at Netflix financials. I wonder if they're more invested in movie production now more than content distribution, I guess we'll call it. Okay. It's an interesting question. Monetary unit assumption is that we express transactions in money. Oh, okay. We express transactions in money, in monetary units. Okay. Time period assumption. The time period assumption says that you can take the financials and break them down into any type of time period that you would like. Weekly, monthly, yearly, what have you. Right? Then finally, business entity assumption. This is the last assumption we'll go through in this chapter. That means that's the assumption that the individual or the entrepreneur who created the business and the business are two separate entities and not one and the same. So if you went down here and you burnt your tongue, unfortunately, on a cup of coffee from Dunkin' Donuts, you cannot sue Dunkin' and the CEO personally because you burnt your tongue. You can sue Dunkin', but you just can't sue the CEO personally. Everybody with me? Okay. All right, going on. These are just three types of business entities that are out there. Sole proprietorships, they're the most common business entity, and they're the most prevalent, right? It's just basically one person. There's no real state filing requirement like to create a legal entity. They're just their they're their own person, and they go out and they just start doing business. Partnerships are when two or more people come together to create a business. And in corporations, they do have a state filing requirement. They are incorporated. And that's when either one person or many people can come together to create an organization. Okay. And this is just a breakdown of each of them, right? How many can have one owner? Proprietorships and corporations can, partnerships cannot. Only corporations are taxed as a business. Only corporations have limited liability. Business entity, they're all business entities, but only corporations are legal entities. Only corporations have unlimited life. Limited liability means that, you know, if something was to happen with the company, you can't be sued for your personal effects. Just the company can be sued. Everybody with me so far? All right, so let's get into the meat of this course, which is we're going to start on this slope on talking about debits and credits, right? I'm going to introduce you to the topic today. Next week, we'll go into it more in depth, right? So right now, we're just going to really kind of go over it in more of a precursory way. So we'll start with the accounting equation. The accounting equation, in its simple form, this is not the long form, this is a simple form, is assets equals liabilities plus equity. Assets equals liability plus equity. And assets are what? They're resources that are controlled or owned by the company. They are represented by things like cash, accounts receivable, notes receivable, vehicles, equipment, supplies, land, buildings. We're going to take a second here. I'm going to give you a second to write these down. It'll benefit you in the long run. Yes.
What is receivable?
Accounts receivable, or any receivable, is when you provided a product or service to a client, right? But you have not received the cash for it yet. So basically, you extended them credit. For example, if you are maybe Lowe's and a company that has been doing business with you for a while comes and asks for so much lumber, you might say, okay, well, you can get the lumber today and we'll send you an invoice for, let's say, $5,000, and you can pay for the lumber at the end of the month. Everybody with me? So when they provide them the lumber, then that's accounts receivable, because it's a revenue. They're going to receive the money. They just haven't received the cash yet. Go ahead.
Interest usually pays on like receivable transactions like that?
Yes, a lot of times you will, what we call accrue, you'll accrue interest prior to you receiving it, right? So you might accrue the interest at the end of the month, but you might not receive your payment until the 5th. I'll move the following one. Good question. Anyone else? Go ahead. You got another one? Anyone else? Good question. All right, so next we'll deal with liabilities. Liabilities are things like accounts payable, notes payable, taxes payable, and wages payable. When you're dealing with a payable, this is the other side of the equation. So instead of you providing a product or service and not receiving the cash, now you have received the product or the service and you have not paid the cash, right? So someone gave you the lumber, Lowe's gave you the lumber, but you have not paid for the lumber yet. When that occurs, there is an expense in the accounts payable that needs to be recognized. Makes sense? But no cash has gone out. This is common for wages. Many of you, you have a wage cycle, like you work from the 1st through the 15th, and you receive the check for that work on the 31st of the month, right? And then as you work from the 16th through the 31st, you'll receive that check on the 15th of the month. So the company will have a payable. Let's say if you work the 1st through the 15th, they'll have a wage payable from the 15th to when they pay you, which is the 31st. Everyone understand? Is you receiving a product or service, but you have not paid for it. Last is equity. Equity, we have capital in or common stock. We have capital out or dividends. Either one will suffice. And retained earnings. They're the owner's claim on assets. What the accounting equation is saying is that assets come into a company one of three ways. One, loans, right? That's liabilities. Two, we can have investment, so capital in and capital out. Well, let me show you on this. Capital in minus, or capital contribution minus dividends. So we can have investment come in and give us assets. And then finally, is what I like to call day-to-day operations or profits. Or slash profits. Okay. And hopefully you know at this time, hopefully if you've taken Business 100, revenue minus expenses equal profits. The long accounting equation is assets equals liabilities plus capital contribution minus dividends plus revenue minus expenses. The long equation is assets equals liabilities plus contributed capital minus dividends plus revenue minus expenses. That long equation is what we will deal with the majority of this class, not the short equation. So please, if I ask you what the accounting equation is, please just don't run out assets equals liabilities plus equity. Or don't take a shortcut. Everyone with me? Now, what I'm going to do at this point is I'm just going to show you some simple transactions. We're not going to put debits and credits to these yet. We're just going to go over some simple transactions. So no worries. No, don't take this is a stressful exercise because it's not. But with these simple transactions, what I'm just trying to show you is keeping the account in balance, right? Keeping our accounts in balance. And when we go through achieving this, how we go through achieving this is fairly simple. It's fairly simple mathematically. We're either going to do a little bit more. We're either going to do the same transaction on both sides of the equation. So if we increase an account by $50,000 on one side of the equation, we'll just increase an account by $50,000 on the other side of the equation. That's one way to accomplish keeping everything in balance. Another way we can do this is that we can do an opposite or equal transaction on one side of the equation. So we can add $100,000 to an account on this side, and then we can subtract $100,000 in an account on this side. And what would happen is what? We would negate, both transactions would negate each other. And then we still would have balance. Almost sound like I'm talking about the force. No, we have balance in the force. But we would still have a balanced equation. So, oh, come on. Yeah, that's fine so far. So let's do the transaction. So transaction number one, Chaz Taylor invests $30,000 cash to start a company. Right? When he invests $30,000 cash in the company, does cash increase or decrease in the company?
Is the cash the asset?
Yeah. Does it increase or decrease in the company?
But it's increased.
It increases. Everyone with me? And cash is, just as you stated, an asset. Now, they use the cash to invest in the company. So does company investment increase or decrease? Increase. There's an increase in investment in the company. What type of account is investment? Huh? Contributed capital, right? Or an equity account. Right? So contributed capital, common stock, they're synonyms, right? And cash increases. So how this would look on the equation is we increase the cash by $30,000, which is an asset. We've already identified that. We increase common stock by $30,000, which is equity. And the accounting equation would be in balance by $30,000. Everybody with me so far? The next transaction we'll do, the company purchased supplies paying $2,500 cash. So we have cash in this transaction. Does cash increase or decrease? Decrease. It decreases because we're going to pay it out, right? And cash is what type of account?
Asset.
Asset. Fantastic. And what did we use the cash for?
Another asset account.
Another asset account, which is
Supplies.
supplies, right? Did supplies increase or decrease? Increase. So we're going to reflect an increase in supplies and a decrease in cash. Now, This is an opposite but equal transaction on one side of the equation. So because both of them are assets, they will negate each other in their effects. Right? So we're going to decrease the cash, but increase the supply. Since they're both assets, we're still going to end up with a bottom line of $30,000. And the equation is still in balance. Questions so far? No. Next, the next transaction we'll do is the company purchased equipment for $26,000 in cash. Did cash increase or decrease in the company? Decrease, right? What type of account is cash? Asset. And what do they use the cash for? Equipment, right? And equipment is what type of account? Did we increase or decrease the amount of equipment in the company? Increase. Right? So cash decrease, equipment increase. And so that is another transaction on one side of the equation. So they negate each other. And so we still have an account in balance at $30,000. Questions? All right, the next transaction, what we're going to do, we're going to purchase some supplies on credit. When we purchase supplies on credit, we're going to use accounts payable. Okay? So, supplies, did we increase or decrease the amount of supplies in the company? Increase. Fantastic. And then did we increase or decrease the amount of credit that the company has taken out? Increase. Accounts payable, what type of account, or credit? What type of account is that? Liability. Fantastic. Good. Okay, so we're going to increase the assets and we're going to increase the liability. And due to the fact they're on two sides of the equation, it should keep this equation in balance. Okay, so we're going to increase the supplies, we're going to increase the accounts payable. Now our bottom line is $37,100, and our bottom line is still in balance. Our next transaction, the company is going to provide some consulting services to a customer and receive $4,200 for it. So when they receive cash, cash is what type of account? Asset. Did it increase or decrease? Increased. And what do we receive the cash for? Consulting services. What type of account is that? Revenue. Did we increase or decrease the amount of revenue the company has? Increase. Fantastic. So we're going to increase the cash and we're going to increase the revenue. And it will look like this on the equation. Okay? Increase of cash, increase of revenue. Now we have a bottom line of $41,300. Go ahead.
How'd you record something that you got like completely for free? Because someone just gives you a building.
Cost principle says what?
But like,
You gotta put it on.
Imbalance the equation.
No. The cost principle says what? You got it for free. So it's a
you're recording
donation.
zero?
So you want to put it on the books. It would be you put a note.
Okay.
Right? Initially, you will put a note. Now, depending on what that is, you might have to do some other accounting to it. But let's say simplistic. Let's say it's just something simple. They gave you some files for free, right? $50 worth of files. You just make a note.
Okay.
That makes sense?
Yeah.
Now, if they gave you $50 million of land for free, that's different.
Yeah.
It's still going to be a no, but then you probably are going to put it somewhere in the finance. You'll do something. That makes sense?
Okay.
All right. Transactions 6 and 7. We're going to pay the rent. It's $1,000, and we're going to pay our employee $700. Now, so we're going to pay them with cash. Cash is what type of account? Asset. Did it increase or decrease in the company? Decrease, right? Now, we paid it for rent. What type of account is rent? Expense, fantastic. How about salaries? Also an expense. Fantastic. Did expenses increase or decrease? They increased. So I'll show you something here in a second. So we have an increase in the two expenses and a decrease in cash. How this is going to bring this account in balance? If you go back to the accounting equation, when we increase our expenses, what's going to happen is the expenses are negative to the equity. So they'll go up, but this will be recognized as a negative. So if we go to that equation, we're going to have a negative 7,000, a negative 700, a negative 1,000 in cash, negative 1,700. On the expense side, it increased the expenses, but because it's a negative, we'll write them up as negatives. That make sense? Does it make sense? If it doesn't, let me know.
Can you explain that?
Okay, so think of it like, let me explain it a little bit here. It's like saying, 3 minus A equals 4. So we know A has got to be 1. Everybody with me? A has got to be 5. Or, actually, it doesn't have to be 5. It's got to be negative 5, right?
Negative 1.
Negative 5. Everybody with me? Because these are two negatives.
Wouldn't it be
Oh, I'm sorry.
Yeah.
Be 5. It's got to be 5, right? So it'd be negative to make that. Oh, I said it right, right? Huh?
Negative
It's
1.
got to be negative 1. I'm doing really bad on my simple accounting. My simple math today. I need to be more like Einstein. You know what Einstein did? He had like a grad assistant come, and then once it got to a certain point, they would just come in and do the simple math for him, right? And he could think of some of the more loftier things, like the logarithms and all that type of stuff. But yeah, it's negative 1. So here, because it's a negative and a negative, this actually comes out to be a positive. That makes sense so far if you think about it. But let's say, for instance, this was just a 1. So A would equal 1, that's a positive, right? It's an increase. But how it affects the equation will be negative. Everybody with me? So it changed the output. Was that good? No good? Try it again. Everybody okay? Yeah. Huh?
Is that for all expenses?
It's for all expenses and dividends. We'll do a dividend in a second. Same situation. So if you go back to the equation, it'll be the same way for dividends, because it's negative on the dividends and it's a negative for the expenses. Same way for both. Man, you guys are mighty quiet, man. Y'all need naps or something? Siesta? All right. Oh, that's going to be on the video. All right, so the next one, oops. provided consulting services for $1,600 and rents a facility for $300 to a customer for credit, right? So for credit, that means that they gave them accounts receivable. This rent, they rented it to them, so that would be accounts receivable. So accounts receivable is what type of account? Asset. Did we increase or decrease our accounts receivable? Increase it, right? And then the rents for the facility and the consulting services, what type of account is that? Revenue, fantastic. And did we increase or decrease our revenue? Increase it. Mhm. That's what it looks like on the equation, right? So we increased our assets, our accounts receivable, and we increased our revenues. And our equation is still in balance, 41,500. Transaction number 9, the client paid transaction 8. So going back to transaction 8, the client pays $1,900 for their consulting services. So when they pay, does our accounts receivable go up or down? Down. So we're going to decrease our accounts receivable. Accounts receivable is what type of account? Asset. Fantastic. And what will we receive in exchange for the accounts receivable going down? Cash. Fantastic. Cash will increase or decrease?
Increase.
What type of account is cash?
Asset.
Assets. Fantastic. Cash will increase. Accounts receivable decrease. And here we have that same transaction on one side of the equation. Same but opposite. In transaction number 10, Fast Forward pays $900 partial payment for supplies on transaction number 4. So they're going to pay part of the supplies that they receive. So when they do this, does cash increase or decrease? Decrease, because they're going to pay a part of their accounts payable. That makes sense? So cash will decrease. They had a credit. Let's go back to transaction number 4. So here's transaction number 4. They purchased supplies. They purchased supplies for $7,100. So they had a credit for the supplies. Everybody with me? Now they're going to pay part of that credit off. So now they're going to, so now transaction number 10, they're going to pay a portion of it off. So when they pay it off, the cash decreases. And the accounts payable is going to decrease also. Because they're decreasing how much they owe on that loan. And here's what it looks like. And so the account stays in balance, $40,600, and we have a decrease in assets and a decrease in liabilities. Our last transaction is our dividend transaction. So dividends of $200 are paid to the shareholders, right? So cash, does it increase or decrease in the company? Decrease. What type of account is cash? Asset. Fantastic. And what do we use the cash for? Dividends, right? Did dividends increase or decrease?
Increase.
They increase. Remember, they were like the expenses. They have a negative. just like the expenses. So therefore, we'll have a decrease in the cash asset, we'll have a decrease in dividends. Questions? Last but not least, let me show you the financial statements. Alright, I'm going to show you the financial statements, and then there's one ratio you'll need to have. The financial statements, or the four financial statements that we're going to create in this course, are the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flow. Again, it's the income statement, the statement of retained earnings, the balance sheet, and the statement of cash flows. So let's start with the income statement, right? The income statement gives the day-to-day activities of the company, right? So it's like the scoreboard, right? We're in the midst of football season, so it's like the scoreboard. It describes the company's revenues and expenses along with its resulting net income, right? I know up to this point we've been saying revenue minus expenses equals profit. For accounting purposes, revenue minus expenses equals net income. So I'll start using net income quite a bit. Everyone with me? But it is a synonym. Expenses. We need to create the income statement first, because the net income off of the income statement needs to be placed on the statement of retained earnings. And the statement of retained earnings is beginning retained earnings plus the net income minus the dividends equals ending retained earnings. Everyone with me? After you do the statement of retained earnings, we're going to create the balance sheet. And what's going to happen is we're going to take the ending retained earnings and put that on the balance sheet under the equity section. The balance sheet shows us the financial position or the financial health of the company. It shows us the financial health of the company. And after you finish the balance sheet, the final statement that you're going to create is a statement of cash flows. And the statement of cash flows will be broken up into three sections: operating activities, financing activities, and investing activities. So operating activities, investing activities, financing activities. Let me show you the ratio. Return on assets is the ratio. That is net income over average total assets. Any questions?